What are stocks and how do they work? Alright, let's dive into the world of stocks. Think of stocks as tiny pieces of a company. When you buy a stock, you're purchasing a small part of that company. This means if the company does well, the value of your stock may go up, and you can make money by selling it later. But hold on, it also means if the company doesn't perform well, your stock could lose value. Imagine you own a lemonade stand. You need money to buy more lemons and sugar. So, you decide to sell little shares of your business to friends. As the lemonade business grows, those shares, or stocks, could become worth more. It's exactly like that in the stock market, where you can buy shares of big companies like Apple or Microsoft. You're part of something bigger, even if your share is small. Common stock market terms explained now. Let's get comfy with some lingo you'll hear all the time in stock trading. First up is bull market. Visualize a bull charging forward. This term is used when stock prices are rising. Opposite to this, a bear market is when prices are falling, like a bear swiping down with its paw. Then, there's the dividend. Companies share a bit of their profits with shareholders, and this is called a dividend. Think of it as a thank you for investing. Lastly, let's not forget portfolio. This is basically your personal collection of stocks and other assets. Just like a music playlist, you want a nice mix to suit your taste, and it helps to manage risks. So, there you have it. A peek into the fascinating world of stocks that makes you both a part owner and a bit of a risk taker. Keep these basics in mind as you explore further. Getting started with buying stocks. Different ways to buy stocks. Jumping into the stock market might feel like entering a whole new world, but buying stocks doesn't have to be complicated. You have a few different ways to do it. You can buy stocks directly through a traditional brokerage firm, which offers personal advice and a range of services. Then there are online brokers that let you trade electronically, providing convenience at a lower cost. If you like the idea of doing everything on your phone, there are also trading apps made just for that. Each way offers something unique, so think about what suits you best. Steps to research and choose the right stocks. Choosing the right stock isn't just about picking a name you know. Start by identifying companies with strong fundamentals like a solid business model, good management, and a competitive edge. Then, dive into their financial health by looking at their profit, revenue, and future growth prospects. It helps to stay informed about market trends and industry news. Are they leading in innovation? Do they have plans for expansion? These are good signs. A bit of homework goes a long way, helping you make smart and confident choices. Opening and managing your brokerage account. Once you've figured out how you want to buy stocks and which ones to start with, it's time to open a brokerage account. This is your gateway to buying and selling in the market. First, decide between a full-service and online broker. After you've opened your account, managing it well is key. Regularly review your portfolio to see how your investments are doing and adjust if necessary. Be sure to keep an eye on fees and don't get swept away by market hype. Investing is a journey, not a sprint. Selling stocks like a pro. Timing your sales for maximum profit. When it comes to selling stocks, timing is everything. Imagine you're on a roller coaster and your goal is to jump off right at the highest point. This way, you'll reap the most benefits. With stocks, that high point isn't always easy to predict. To get close, keep an eye on market trends, company news, and economic indicators. These can signal when a stock might be at its peak. It's not just about selling when prices are high, it's about selling before they start to drop. Practicing patience and staying informed often pays off. Understanding capital gains and taxes. Once you've sold your stocks, you'll encounter capital gains. Capital gains are the profits made from selling an investment at a higher price than you bought it. Here's a catch: those profits are usually taxable. The tax you'll pay depends on how long you held the stock. If you held it for over a year, this is called a long-term capital gain, which generally has a lower tax rate. On the flip side, holding for a year or less leads to a short-term capital gain, taxed at a higher rate. It's wise to plan your sales accordingly to minimize tax impact. Some investors choose to hold their stocks longer just to land in the lower tax bracket. But hey, let's not forget that there are strategies to offset these taxes. You can deduct losses from other investments or use tax-advantaged accounts. Both let you keep more of your hard-earned money. Timing and understanding taxes might seem like boring stuff, but mastering them puts you on the path to selling stocks like a pro. Market strategies for beginner investors: long-term versus short-term investments. When you're just starting out in the stock market, it's important to grasp the difference between long-term and short-term investments. Long-term investing involves buying stocks and holding onto them for several years, often taking advantage of compound growth. This approach can be less stressful as it rides out market volatility over time. On the other hand, short-term investing focuses on quick gains and requires frequent buying and selling. It tends to be riskier and demands constant market monitoring. Understanding your financial goals will help you decide which strategy suits you best. If you like stability, long-term might be your path, but if you're up for a challenge, short-term could be intriguing. Diversification. Why it matters: diversification is like having a safety net in your investment portfolio. Imagine putting all your eggs in one basket and then tripping, "There goes breakfast." By spreading your investments across various stocks or sectors, you minimize the risk of losing everything if one stock takes a nosedive. Think of it as investing in technology, healthcare, and real estate instead of just one area. This way, if a particular industry faces setbacks, others might keep your portfolio steady. Diversifying helps protect your investments and potentially enhances returns by balancing risks and rewards. It's a fundamental strategy even seasoned investors follow. Risk management basics. Risk management is vital to any investment plan. It involves identifying your risk tolerance, which is essentially how much risk you are comfortable taking. For beginners, setting stop-loss orders can prevent big losses, automatically selling your stock if it falls to a certain price. Consider starting with investments that have a low to moderate risk profile as you learn the ropes. Managing risks isn't about avoiding them altogether, it's about understanding them and making informed choices. This ensures you're not investing more than you're prepared to lose, helping you cultivate a more resilient investment approach. Analyzing market trends and indicators using technical analysis tools. Technical analysis tools help you understand stock price movements by studying past market data, mainly prices and volume. These tools include charts, moving averages, and oscillators like the Relative Strength Index, RSI. Imagine looking at a graph to see how a stock's price has been changing and spotting patterns that might predict future changes. By learning how to use these tools, you can make more informed decisions about when to buy or sell stocks. Interpreting stock market news effectively. Staying on top of stock market news is crucial for making smart choices. This includes understanding how big company announcements, changes in federal interest rates, or even geopolitical events can impact stock prices. Not all news will require action, so it's about picking what's truly relevant. For instance, if a major investor is buying lots of shares in a company, it may spark interest in that stock. By regularly reading financial news and developing a sense of how it affects markets, you can better anticipate market shifts. Importance of economic indicators. Economic indicators are like the health report of an economy. These include data points like unemployment rates, GDP growth, and inflation figures. Understanding them can give you a heads up about the economic environment your stocks are operating in. For example, low unemployment often boosts consumer spending, which could mean good times for retail stocks. Conversely, high inflation might indicate a cost squeeze for companies, possibly affecting their stock value. By keeping an eye on these indicators, you understand the bigger picture surrounding your investments. By learning how to analyze these trends and indicators, you'll gain insights that help you navigate the world of stocks with confidence.